If you were only in one deal, if you had bad timing and you invested beginning of 2022 into one syndication and it's turning you off to the business, that's probably a mistake. You really, if you have more of an allocation, I mean, going into a deal or two now, whether it's through a fund or even an individual syndication, the deal pencils at a 6.5 interest rate, there's a lot more upside, and that will balance things out. I often use that analogy of if you invested $100,000 in 1929, a day before the stock market crash, it would take you 12 years to break even. But if you invested 6 months before in equal installments and 6 months after in equal installments, within 2 years, you'd be up.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everybody, to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing fund manager who has a ton of experience in private capital as well as real estate syndication funds, Mr. Jack Krupey. I hope I pronounced it correctly.
Yeah, you did well.
Awesome, thank you, Jack. Is it an English name by any chance, or what?
Yeah, I think it's like from kind of Eastern Europe, kind of modern day Czechoslovakia, but I think,
Gotcha.
My great grandparents came over. They might have changed it at Ellis Island for all I know.
Gotcha. Okay. Yeah, because it's not a very usual. I think it's probably my first time seeing your last name, so it's probably not very common.
Yeah, definitely not very common. It might have been as long as Alex's actually back in the day. You never know.
It probably was. Awesome. Okay. So Jack has been in real estate for 20 years now, starting with single family houses, and worked in Wall Street during the financial crisis buying non-performing notes. He was part of a private equity fund that funded over $3 billion of non-performing note purchases. That's amazing. I remember those days. There were packages being sold off like crazy. I was involved in a number of daisy chains type of deals. So that was a lot of fun. Jack has participated in hundreds of millions of dollars of syndicated apartments and self-storage deals. He does fund of funds, co-GP funds, LP funds in multifamily self-storage, student housing, senior housing, light industrial. So with that, let's welcome Mr. Jack Krupey. Woo-hoo!
Thank you for having me.
Awesome. All right, Jack. I am super excited. As I was reading your bio, I was like, man, I want to learn a lot, especially about all the stuff you're doing around funds. I know you have I know you're actually doing a capital raise right now. I got into your funnel, I think, in my research of you. And so I'm getting texts and email of the deal that you're promoting. So we'll touch on that as well. Give us a little bit of, share with us a little bit about you. How did you get into this business?
Sure. So I actually went to college. I thought I was going to be in the information technology industry. It was the late 90s, the dot-com boom was going on. And I was really into computers and technology. I was kind of a nerd, and ended up graduating during the 2001 dot-com crisis. So jobs were more scarce, and I'd read Rich Dad Poor Dad previously, and then I picked up one of those paperback books, How to Make Money in Real Estate and No Money Down, and read it cover to cover, and I called my college landlord, and he was up, this was up in Rochester, New York. I'm from outside of New York City, but Rochester is a very inexpensive market. You could buy a 2-family house at the time for $60,000, and it would rent for $1,100 a month. So, my college landlord was also a broker, and 30 days later, I had a house, no money down, and then another 2 months later, I had another one. And within a year, I did have an IT job, but I quit my job and was essentially full-time in real estate a year out of school, just using kind of creative financing, low money down, 5% down countrywide loans. And
oh wow, I remember those.
Just kind of started raising money by accident, just by telling people what I was doing. I had some, investors that were looking to back me on deals. So I started really informally, whether it was private lending or, in a couple of cases, just starting an LLC, and, had a good run until 2008 when everything froze. I've been through a few different crises already, the dot-com and then the 2008. And it's probably the best thing that ever happened to me, because of that, I ended up kind of regrouping and moving to New York City. And a bunch of the hedge funds needed real estate people because all these bankers were buying non-performing loans. So I got in during the heart of the financial crisis. I was on Wall Street in December 2008. And it's funny, you talk about those daisy chains. And for those that don't, I don't know how common the term is, but it's really just like a bunch of brokers you see where like someone on LinkedIn says they has a portfolio of loans, but when you call them and talk to them, they're just talking to another broker. And I had multiple times where those joker brokers were trying to sell me my own loans when I worked on Wall Street.
That's funny. That is funny.
Spent almost 10 years, in private equity in New York. I actually worked on Wall Street, and then most of my time was in Midtown. And then eventually, just by running a small fund myself, was approached by a private equity fund that wanted to move into the space and buy at a larger scale. And we formed a joint venture with that private equity fund. It was all their capital, and that was the fund that grew to over $3 billion in acquisitions. And, we used, we had lines of credit with both Goldman and Nomura. We did securitizations. One of the securitization buyers was actually Greg Lippman, was one of the characters from The Big Short. They changed his name in the movie, but in the book they use his real name. He was the Deutsche Bank. He was the one at Deutsche Bank that was, trading with both sides. Grew that business and realized I was kind of burnt out with the New York City lifestyle and the high tax rate. And unlike real estate, the mortgage business doesn't really have the same tax write-offs, and especially if it's structured more like a fund. So I'd been passively investing in syndications for a number of years. And once I actually left the firm I was a founder of, and they actually bought me out. So I had a pile of money and was going to invest in syndications. And I decided to build a business around it rather than just be a retired passive investor. I wanted to... because for years I wasn't allowed to take small checks. I was only working with institutional investors, and they were handling the capital raising side. But I had people for years asking if they could invest with me, and we were an institutional fund at that point. So I really wanted to open up a fund to the more accredited investors, because I think there's a real lack in the market. I think those that are worth 1 to 20 million, too small to have a family office. There's not enough exposure to real estate in the syndicated asset classes. So part of my mission is to make that more available and to coach and educate and get more people invested in what I do feel are superior deals to index funds and the Vanguard and the whole kind of traditional Wall Street system. So it's kind of a long-winded initial story. So I'll pause for a second.
Yeah, I absolutely love that. Love the story, and I would like to hear more too, the pros and cons of taking on institutional money for your fund. But before we go into that, can you share with us what your business model is now?
We are not an operator, and I made a conscious decision to not try to be an operator at this part of the cycle. A, it's a lot of work, and B, just the pursuit costs. To look at 200, 300 deals to find one good one and to be competing with multiple investors, multiple offers. It's really, I've kind of been through that already. And, it's coming in this part of the cycle. I just made a conscious decision. I wasn't going to try to create an operating business. And because I'd already been a passive investor, a number of the partners I already had vetted and already had success with, it explained to me the aggregator or the fund of funds models of there's room to be a minority partner in a deal if you can aggregate capital and be a consistent programmatic investor. It's one thing if you're coming in big on one deal, but it's another thing if you're there, on almost every deal, and they can rely on you for a certain amount of money consistently, and to really help as a legitimate co-GP partner and be part of the team and advise and try to help make the project a success. So I built the business around that model. And we actually have two different models. One of the things I think I'm a little more unique of is I have a true diversified fund where it's one LLC that's invested in multiple deals. And that is, something that a lot of my kind of ex-New York, ex-Wall Street, people that are not in the real estate business at all and maybe want to move a few $100,000 into syndications, I found a lot of them had angst about what deal to pick. And did they want to put $100,000 into one deal in Dallas or one deal in Florida? So I wanted to have a solution that provided true diversification, and we raise money over the course of 1 to 2 years and invest in multiple deals, so that an investor who comes in early gets to dollar cost average across all the other deals we invest in. An investor who comes in towards the end of the fund gets to have the exposure to all the other assets we bought, and then we'll buy another asset or invest in another asset. So that's our offering. It's a little different. And then separately, we have an individual deal offering where we'll invest in individual syndications. And we primarily do that through the Avestor platform. I think I see Badri on here. So that was a real game changer for us because it allows us to make smaller allocations without having to rely on the sponsor, without having to give up our investors to the sponsor. Even if we trust the sponsor, I want to have control over the communication. I want to have control over sending the checks and the wires. I want the authority over the investor, and I want to be in the loop on everything that's happening. So we use that platform to invest in individual deals in almost all scenarios. There's always the 1031 exchange or a select deal with close clients where if it's in their better interest to go directly into the deal, we'll do that on an advisory basis. But those are the two key vehicles that we run right now.
I see. So are they two separate funds? Is that correct?
Correct. It's two completely separate Reg D funds. And we actually use different software and everything. So our original fund, and when we started in 2020, we used Syndication Pro for our diversified fund, and we just kept it there. So we have our second fund on Syndication Pro, and then separately we use the Avestor platform for all of the individual deals where people only want to be in one deal. And,
Gotcha.
and that segments all the economics completely. So, and they works,
Okay.
they work well, and they're kind of complementary to each other as well, because sometimes we'll market a deal and the investor says, well, I really would rather have the diversification. And then sometimes we have an investor find us and they're like, I really would rather know what I'm getting into. And they may come in looking at the diversified fund and end up in the Avestor platform for the customizable fund.
I like that. Okay. And are they both 506Cs?
Correct. Yeah, I started off right with the 506C with all the social media and all that right now. I thought it was too big of a risk to not do a 506C because I didn't want to be in a spot where I say something on a podcast or we're just
Right.
to me there's just way too much exposure. And I've not had a single. We've had one or two investors that weren't accredited that thought they were or that couldn't get through. But in general, using the Verify Investor or getting a CPA letter, it hasn't stopped us from taking on any significant investors over the last 3+ years. We've had the publicly available funds.
Gotcha. Okay. The first fund, I assume it's a blind fund, right? The diversified fund is a blind fund. How much asset under management is that fund, or the total fund amount?
Yeah, sure. The initial fund we raised just under $10 million in just about a year. And that was the friends and family round. It was blind to start, but as we acquire assets, we have full disclosure over the assets we've already acquired. And, because we always have new opportunities, we'll use the opportunities that come across our desk and market the opportunity that can be either invested through the fund or now through the Avestor platform. But, there's a balance between selling the fund and really still using an opportunity, even if the goal is to get investors into the fund that's going to ultimately invest in the individual syndication opportunity.
Right. And is that fund, that diversified fund, is that fund still capped at 10 million now?
Yeah, we made a decision to close it because
Okay.
there's a number of ways to structure funds. There's funds that are kind of open-ended with net asset value calculations. There's funds that have multiple closes and penalize, the late investors pay a penalty to the early investors. We used a format that I knew a few other investors had used where it's very simple. The preferred return starts the day the wire clears. Everyone gets the same profit split. And for that fund, we do a 70-30 split ourselves. And what we do is any preferential economics for co-GP actually go to the fund itself. So I don't generally use the term to market to kind of the retail accredited investors, but it's closer to a co-GP fund, in addition to the diversified fund, because the gross return should be higher. So to be fair to the early investors, it just makes sense to leave it open for perhaps a year, maybe a year and a half, and then close it to new investors and start a new fund. And essentially run a new fund every year to year and a half. And that doesn't really, if you're coming in a year in and we're in a 3 to 5 year deal, the IRR is not that much different for a late investor compared to early investor. And the early investors will make a higher overall profit multiple because they'll get a preferred return for a longer period of time. So, it's been pretty well received. And, especially with investors that are not super familiar with syndications, we have a lot of investors, it's their first alternative. Maybe they've owned a single family house, but a lot of investors, it's their first syndication. So, we spend a lot of time just explaining the cash flow and how it works and what a preferred return is and what the rough schedule of the return of capital would be, based on some syndications exiting in year 2 or 3, maybe some of them going year 5 to 7. So I was, surprised, and coming from the Wall Street background and being in all these structured deals over the last 15 of my 20 years, I have to catch myself and make sure, I don't want to say dumb it down, but I definitely had to change my language and explanation and realize that even very successful and sophisticated in many other ways investors were not as familiar with, the cash flows and how these private placements typically work.
Right. Okay. I would like to dig deeper into each of your fund, but especially the first fund right now. So you had to close it. That means that there's no more investor that can go into that fund at this point. Is that correct?
Correct. So we closed it to new investors, and we're in what I call the harvest period. All the assets are still, and I'll make one more clarification. So we did have we had 2 exits during the initial phase where we were raising money. And what we did was we reinvested those profits.
Gotcha.
So now that we've closed it to new investors, now we're in the harvest period where any capital event is a return of capital. So now it functions more like an individual syndication, where if one deal has a big cash out refi, we'll return capital to investors. If something sells, we'll return capital to investors. And the difference between one syndication is most of the time in this market, you're going to get all your money back when it sells. But in this scenario, there's going to be a balance of return of capital as well as a preferred return. So we walk investors through the scenario that say, hey, 3-4 years from now, you may have 80% of your money back. So you're only going to get your preferred return on 20% of your money because the rest of it's back in your pocket. And hopefully you invest in a new deal with us. But if not, you have that money, you could buy treasuries, you could put it back in the stock market. And there'll be a period of time where we've given you all your money back, but the fund still owns some assets. So at that point, you're getting ongoing dividends, 70% of the profits is perpetuity until the last asset of the fund sells.
Right. Okay. Can you share with us the terms? So if I'm a passive investor investing in your fund, what is the split? What's the pref and what's the split to the passive investors?
It's a 70-30 split, and we had 2 share classes, one with a 6% pref and one with an 8% pref. And the 8% pref was for investors over 250,000. And as interest rates have moved, we were able to waive the minimum for the other share class. So, as treasuries are at 5, we're anyone who's closer to 250 than 50, we've tended to make exceptions and, provide incentives for them to come into the fund, just given the higher interest rates currently.
Gotcha. Okay. And you mentioned that the pref starts the minute the wire is confirmed. Does that mean that by the time, I guess, especially when you first started the fund, I assume that when you started collecting money, you haven't identified the property yet, or have you? When it first started for you to start paying out pref?
Yeah. So fortunately, I had more deal flow, and I've always had more deal flow than capital for the most part. And that's because I'd been investing passively before I started the fund. And at this point, we have 15 plus groups that we've made investments with. So if you do back of the envelope math, the average syndicator looks at 200 deals and maybe does 2 or 3 a year at most. But we've got 15 groups. So we've got 45 deals a year to pick from. And I'm very conscious of cash drag. Cash drag is what gets so many fund managers in trouble. And, that often happens when you raise all the money up front and then you're in a rush to deploy it. I mean, that happens with SPACs in some cases. You've got to do a deal or else. The benefit of just raising money over a 12-month period and not having all of it come in at once is we can basically deploy as we go. And we often will use a new opportunity as a way to get people off the sidelines and into the fund if we're on a push to raise X number of dollars in, say, 30 days as part of a co-GP in a deal. So fortunately, we haven't had any real issues with cash drag. And we function a lot more like a syndicator in that regard. Of when we have a deal, we pick up the pace. And if somebody wants to put 50 grand in, I'm not worried. If somebody offered me 5 million tomorrow, I may say, hey, can we take that in 3 installments? And I try to schedule the money to come in a way that makes sense without losing the investor.
Right. I understand. Okay. So what's your typical amounts that you invest into a deal from your fund?
So we've been targeting $500,000 to $1 million per allocation. And, I'd certainly like it to be more. And, as much as I've raised over the last 2 decades, the last 12 months has been one of the more challenging periods too. But yeah, for diversification purposes, I'd say $500,000 to millions average. And I'd love to get to the point where we can do probably a little bit less deals, but really go deep on a few and do 3 to 5 million a deal and be, a real significant part of the operation over time. I said earlier, I made a conscious decision not to be an operator, but longer term, I'd like to back into being an operator. And instead of having to compete on the market with deals listed, through brokerages and competing with highest and best offers, I'm invested in 40 different deals. I'd like to cherry pick the 1 or 2 best ones that still have upside. And instead of just letting them sell to someone else, I'd like to actually, do a recapitalization and maybe come in as more of a lead investor the second time around. And I think there's going to be a lot of opportunity for a lot of us, especially with the higher interest rates and deals that, maybe got slightly delayed on their business plan where, there's still some upside to go back through and refinance something into fixed rate debt. And let the plan take its course. Whereas some of these deals, I know people have just been hamstrung by the higher interest rates and maybe lack of cash flow to finish the renovations and do things the way they wanted to.
Right. Okay. And then when you invest in these deals, you mentioned that you are a co-GP fund. That means that your fund doesn't just go in as an LP; it actually goes in as a co-GP. Is that correct? Or
Yes,
both?
yes. And there's 2 ways to do that. And well, actually, there's 3. In some scenarios, there's just a better share class. So we don't 100% have to be a co-GP, but we're not going in as just a retail investor. I can't go in and get the same terms as some dentist putting 50,000 into a deal, just because all we're doing is adding extra fees for our investors. So either like the way Rise does it as an example, they'll have a separate share class, and just give a much better split or a higher pref for larger investors, or we're in the GP, whether we're written into the operating agreement with a legitimate piece of the GP, or there's a side letter, that provides a fee break and, to pro rata share through some type of profit participation in the GP. Either way, if it's at the scale we're at now, I don't expect voting rights. So part of the long-term plan is to become more and more of a full service co-GP fund where, we perhaps sign on a debt as needed, and we have some major decision rights, because nothing's worse than a deal selling on December 31st and you have a big capital gain and you don't have the chance to redeploy capital, and your investors are mad because they have a positive K1 for a change.
Yep. All right. So let's switch gear a little bit over to your customizable fund. And so with the customizable fund, is it an open-ended fund?
Correct. It is an open-ended fund. One of the limitations is there's a 99 investor limitation through the SEC. I think, and again, I'm not an SEC attorney, but I believe the name is the 1C3 exemption, where if you're essentially a fund of funds and you're allocating to other deals under 99 investors, it falls under an exemption. But once you go over 100 investors, there's something else with the Investor Act. There's just additional reporting, additional compliance, and excited about tackling it at this stage. But other than that, there's really no limitation. We can put any number of different syndications in there. We can do really any size deal. We can do debt. We can do a standard real estate syndication, and even other alternative cash flow streams. If it's a private placement and has an operating agreement, in general, we can put almost, from talking to our SEC attorney that helped us create it along with the investor, we can essentially do whatever we disclose.
Gotcha. Okay. In the customizable funds, do you raise for just one deal at a time so that way you can better direct the money into a specific deal? Are you okay with raising multiple deals?
So we've tended to focus on one type of deal at a given time. For example, if I put 2 multifamily value adds up at the same time, I'm probably cannibalizing myself. But we do have a debt fund. We generally leave up there monthly. It has a monthly closing. It's a hard money lending fund. So we have a hard money fund that's up there consistently. I am looking to add a few other offerings that are more consistent. Right now there's a lot of investors really want cash flow, and especially monthly cash flow. So we are, looking for other alternatives to the multifamily that have, more consistent cash payouts. Primarily debt related. So yeah, it's a balance. It's not that we wouldn't put two deals up there if we thought there was enough demand, or perhaps one was in Florida, one was in Texas, or one was more of a steady Eddie cash flow deal, like lower loan to value and immediate cash on cash return, and the other was a heavy value add with a higher IRR. Certainly you never say never, but in general, at least at this stage, we're generally trying to focus on one deal.
Gotcha. Okay. So far with these two funds, you have been primarily raising from retail investors. Is that correct?
That is correct. Yeah, we do have one group, which is more of an advisory relationship that, they actually put some money into the funds just as more of a research and development. But, long-term moving forward, they're more likely to go in as tenant in common, directly into deals alongside of us. And that's something else I can monetize, although not directly through management fees. If we're, sourcing an opportunity and bringing them in for, say, a $5 million check as a co-GP next to us, we're going to get a little bit of the co-GP ourselves for bringing in those larger investors. So you can really monetize it a number of different ways.
Gotcha. I love that. You came from the world of institutional money, and now you're in the world of retail money. So share with us some of the pros and cons in each of those.
Maybe I'll spend a little more time on the institutional, because I see a number of people who probably have a lot more experience with syndications. Not many of us have done a $3 billion deal with it. So you can direct me as you want, but the institutional capital, obviously the biggest benefit is they can write big checks. There's hundreds of firms that can deploy $100 million or $1 billion. They're sophisticated. They know their numbers. They've got infrastructure and support, accounting. So the downside is they generally want a significantly more amount of control, and you're going to get less fees. So a smaller piece of a bigger pie is, usually a good thing, as long as you get along with the partner and you're aligned on the same page. For me, eventually they owned us because we ended up doing a kind of a merger, and they ended up owning a majority of the new company, which we merged together over time. It was still a lucrative deal, but it became a job at some point. Some of the hidden things was there's always some type of compliance issue. We would say, well, why can't, let's do this. And they're like, oh, well, we can't do this particular deal this way because of something. So the legal and the compliance can be, there was always this random surprise of why can't you do something this way, including one of the funds had a lot of foreign investors. So because there were foreign investors, there was like a thing called FIRPTA for like foreign income tax reporting. So again, this was more mortgage related, but to take title to a property, even through a foreclosure, there was different compliance. So it was a lot of unexpected things that popped up, and it was always something. But yeah, again, the positives are, they're writing deployed over $100 million and money was never an issue. That was that. And then I made a conscious decision to move more to the retail side. And some of it was just where I am in my life. I was kind of burnt out from New York. I was tired of paying a 50% tax rate. And I have been an evangelist. I was the guy in my 20s that said, buy a 2-family house, live in half of it, do the house hacking thing. And, in 2008, before we went really institutional, there was a few years where I was getting a lot of people into buying non-performing mortgages. I had a lot of my real estate contacts who, it was having a hard time finding deal flow. And I was like, hey, buy mortgages. It's the better way to get properties. And frankly, we made more money modifying loans and selling the loans back to banks than we did actually foreclosing. So for a lot of the tired landlords and burnt out landlords, especially in that 2008 to 10, it was like, hey, the paper side of the business is actually superior. There's no tenants, no toilets. And you could still make a buck in the paper side of the business, but I feel like that business has matured a lot. And frankly, up until, especially a year or two ago, there's a lot less non-performing loans. Everyone has equity. We'll see what happens in this cycle. I think, I'm not expecting a residential cycle to crash, but on the commercial side, the office space, there's going to be some pain in the commercial side for sure. So there's going to be probably some opportunities to buy loans. The retail side was it was an adjustment for me. I'm a fast talking, not in a bad way, but a fast talking New Yorker. I do know my stuff, so I tend to rattle off terms, and I really had to kind of reset myself and think back to that evangelist side of like, ultimately I want to help people, and I want to help people get to financial freedom. So I needed to like refocus myself on the emotions, what's the end goal, what's the not just the problem of a potential investor, but the pain of a potential investor. And just a number of different masterminds. And Tim and I, we've seen each other at a few different events, and I continually digest that side of the business, which I kind of lost sight of, because I'm just like, I already kind of know the stuff, and I'm like, you'll save 50% of your taxes, but in reality, it's like much more about what's the lifestyle, what are they looking to accomplish. And I enjoy that. I've forced myself to slow down a little bit and really hone in on not just how I think I can help people, but really understand what their pain is, to make sure I'm really addressing what we might be able to offer them to what can really solve their ultimate problem and accomplish their goals.
Yeah, I love that, like getting in touch with, their reason why and your reason why, and the whole, retail investors definitely is all about the emotions and the stories. We want to invest in things that matters to us, right? And so, yeah, that's good. You had mentioned about dealing with foreign investors in the past. Are you targeting foreign investors now with your funds?
It's not the primary focus, but yeah, we are. And part of the reason is when I was leaving New York and trying to figure out what to do, I had a non-compete. And so I did a global MBA program through Kellogg University, Northwestern in Chicago. And it was partnered with Hong Kong University of Science and Technology. So I spent 2019 flying back and forth to Asia. So I have connections in Hong Kong and Singapore. And Zach Garizio, who works with JCAM, he's from California, but he lives in Medellin, Colombia. And there's a lot of investors there, given some of the political turmoil and the just devaluation of the peso. And then one of my classmates lives in Argentina. So I'm actually going to go to Argentina the end of August. And Argentina has a very bad currency crisis, almost 100% annual inflation. So there's a lot of people interested in moving money, and sometimes they have a hard time getting it out, but a lot of the wealthier people have it stashed. So, when I talk about being an evangelist, there's another way. I think too many foreigners just buy a condo in Miami or Seattle or New York and get like a 2% cap rate. And that's just sort of all they know. So I do want to, I do like getting the education out there of, hey, there's a better way to invest if you're looking to, get money into the United States. We have a CPA that has some level of specialization with, helping foreign investors get their ITIN, get a bank account opened. KYC is still kind of a work in progress. There's a thing called a Reg S, but foreign investors could also just come in under the standard private placement. The burden of what level of proof for a foreign investor is a little nebulous. At this point, we're still trying to make sure they check the boxes of what an American would invest, would do. So we try to still, confirm the same accredited standards. I'd encourage anyone who's taking investors to talk with your own, attorney, CPA, compliance, just to make sure you're doing things right. And then, it really is better if they do it through an LLC, because I know there's some weird estate stuff where if they die and it's just in their personal name, there's a huge estate tax. But if it's in an LLC, it's, I think, minimal to zero. Okay.
So an ideal situation is they start an LLC here, and then they transfer money from their country to their LLC here. And then so from your perspective, it's just you're dealing with the LLC at that point, a US based LLC. So, I mean, do you still have to be concerned at all that they are a foreign person?
Well, you could see I think part of the compliance and the onboarding would be to review the operating agreement as well. And you make sure of that. And that's the simplest way to get started with investors. If you're going to raise millions, well, if you have a big family office or a high net worth person, chances are they may already have Cayman Island or a BVI type of company. So that's the other alternative, is they have a blocker, which essentially, and if you want to spend 50 grand to 100 grand, you could actually set up a foreign feeder company where any foreign investor just invests into the Caymans or BVI, and then that BVI fund invests into the US fund. So there's a way to do it at scale. You need to know you've got millions of dollars raised. I wouldn't recommend anyone to just do that on spec with the hope of raising money later. You need to have an anchor investor and like a real sphere of influence. Like you're going to focus your entire business, a certain country to justify that. Otherwise, I think it's not, if someone's willing to file a US tax return, it's not that onerous to get an investment, an LLC set up and an investment into the US.
That's very cool. Yeah, it's always fascinating to learn about, foreign investors coming in, and because I'm originally from Vietnam, and I've been talking to a few people that are from Vietnam about what it would take to transfer the money here, because the government over there do not want money out of their country. So I think, yeah, so it is interesting to learn these things. Let's talk about raising money right now, capital raising. What are some of the challenges that you're seeing in today's marketplace when it comes to capital raising versus what it was in the last few years?
Yeah, I mean, it's all the negative headlines, really. We talk about the emotional side of investors, and it's like every other day there's a CNBC piece or an article, or the Real Deal did I don't know whether it was a smear piece. Certainly for some of the operators, I think it was a smear piece on some of the prime, top operators on, that, oh, they all have bridge loans. They're all, it was really just a lot of generalizations. So,
right.
But those things actually, those make it difficult. Like every week I'm getting an email, even from a current investor, saying, hey, are things okay? Is this gonna affect us? And add to that, I mean, there are some deals. I mean, we have a number of deals with fixed rate Fannie Mae debt that are paying distributions like clockwork in Fund 1. But, there are some deals that, are likely not to have distributions until the property sells at this point. And it's just renovate as much as possible to raise the rents and raise the NOI and get to the point where you can sell a refi. So, there's even some internal headwinds from deals that, have some challenges. So, the key is, I focus on just dollar cost averaging. For an investor who hasn't gotten into investing yet, now is as great a time as ever, because if a deal pencils out in today's interest rates, there's a lot of upside when rates drop and pricing is down from the peak. I do have sort of an informal tax, I'm certainly not a CPA, but, I'm living the tax depreciation, that side of it. So a lot of my type of investor avatar is somebody who's higher earning and tax conscious. So I try to work as I don't want to say consultant, but sort of have an informal mastermind to try to really, go through their situation and talk through whether it's self-directed IRAs, whether it's their spouse potentially qualifying as a real estate professional, whether it's them making a career transition. So, I'm really I enjoy those conversations. So I'm really trying to build, a mini mastermind group with investors that are not just transactional to get, a few $100,000 into one deal. It's like being a bigger part of their overall financial plan, over the next decade or two of their lives.
Any of your deals that you invested in, that your fund invested in, had a capital call?
There's been one so far, and it was only $15,000. And the property, this was not a bridge loan, luckily. It was, so they didn't raise as much to begin with. So it's just a small, and we're a minority investor in the deal. So it's a very small one. And it's just like to finish remaining renovations and get it over the hump. There's probably going to be one or two coming from the fund. Doesn't mean we will make a capital call to our investors, especially with a diversified fund. We have some reserves, and no investor is obligated to make a capital call. So it does, one of the benefits of that fund is it does shield investors from potential capital calls. I'm expecting there may be, of all the deals, we're in over 40 deals. I'm expecting there'll be a few. In general, of all the deals, it's the rents are still going up. The NOI is still increasing. It's really, at this point, the capital calls are really just to smooth out the cash flow from the debt service, and the business plans themselves still seem to be moving in the right direction. And as long as the 5 and the 10 year stay significantly lower than SOFR, I'm still, any deal with a capital call, I'm still reasonably optimistic that it gets it to a point where at a minimum it's refinancing and stable, and just becomes a longer hold versus a deal that has real major challenges.
Right, and it plays well into your message of diversifications as well, right? So, even though, you're diversified among 40 plus deals, and so a few capital calls is not a major hit on the fund.
Yeah, absolutely. And if you were only in one deal, if you had bad timing and you invested beginning of 2022 into one syndication, and it's turning you off to the business, that's probably a mistake. You really, if you have more of an allocation, I mean, going into a deal or two now, whether it's through a fund or even an individual syndication, the deal pencils at a at a 6.5 interest rate, there's a lot more upside, and that will balance things out. I often use that analogy of if you invested $100,000 in 1929, a day before the stock market crash, it would take you 12 years to break even. But if you invested 6 months before in equal installments and 6 months after in equal installments, within 2 years, you'd be up. And I think the same goes for real estate, 2006 to 2010 or 11. You take any 5-year period, if you're dollar cost averaging and investing consistently and conservatively, that's the secret sauce, in my opinion. It's really tough to time the market.
Right. Yes. All right. So now let's talk about marketing. What are all the different marketing channels and types that you're currently using to market your funds?
So, we have an email list. We're on all major social media. We launched the podcast over a year ago called Alternative Investor Mastermind. We just signed up for Threads. It's not in our normal rotation yet, but, Instagram Threads, a lot of people, they got, tens of millions of users in a few weeks. So, we're on all the major platforms. I'm trying to do a better job of going live. So kudos to you for, getting this live stream with, this many, people in attendance, but I know being live is part of the algorithm. We're trying to do more live events as well, just sort of whether it's a lunch and learn, whether it's a happy hour networking. I live in Puerto Rico, where there's a lot of accredited investors all within a small geography. So we're trying to do some more networking events and get to know you, and from New York. So I'm trying to get up to New York a little more systematically to participate in some of the meetups there and just get FaceTime with a high concentration of potential investors and friends.
Right. Okay. And then I think I might have seen some of your Facebook ads or something. Are you guys running paid traffic as well?
Yeah. We've been running paid traffic for a year and a half, almost 2 years now. And we've had, it's a long runway. So, with Facebook and paid ads, there's a small percentage of people that are already investing in syndications and will be already looking and have money for some deal. And maybe 1 out of 50 is like, you have a conversation or two and they immediately write a check, but more importantly, it's getting them on, growing the mailing list, growing the branding. I've had a few different counterparts of mine say that, the average time on a mailing list can be 9 months or more before someone invests. So, sticking with it. Our cost per lead, though, is pretty good. It's under $30 consistently for a Facebook lead. And then the retargeting has been under 20. And that's people who've been to our website or, already had the cookie on there. And, look, that means probably 1 out of 5 or 1 out of 10, maybe we'll schedule a call. So our cost per call is still significantly higher. And I don't know that we have enough timing to have cost per dollar invested, but for anyone in the capital raising space, if you raise 100 grand, I think it's worth at least $10,000 lifetime. Use the MBA term, lifetime value of a customer. So, if you could afford it, you have the wherewithal to stick with it for a year or two. I am confident it will be a profitable endeavor. We're also working on a virtual summit, which has a little lower barrier to entry. It's like someone may not book a call because they don't want to be sold to, but they may sign up to a summit for free information. So we're also experimenting with some of these other lead magnets to get people in the door, get people, just grow our audience.
That's good. And when you run your ads, are you running to a deal specific ad only? Or are you running them to an educational content, or both?
We've tested a bunch of stuff, and the best producing ad is like a simple one that has passive income and a return target, and just very simple, just a standard, just JPEG image with a little headline on it. We've run,
interesting.
I recorded some content of, we hired a studio. I recorded some content with me in front of a green screen. We've done some longer form. We have a Wealth Without Wall Street ebook. And I realized there's another firm that has Wealth Without Wall Street. So we're kind of scaling down that. I didn't realize there was like someone else who had it, I think, trademarked. So, but that goes, we've done a lot that was more just try to speak to the avatar. But, really what seems to work, so that ebook, we had an ebook about like get off the Wall Street roller coaster does well. And then just as a standard ad that just mentions passive income with the return, that's been the top producer.
That's good. In the keyword passive income, in my research, I did a ton. I look at a ton of Facebook ads. Went to Ad Library, study in a bunch of other syndicators that I know. And the term passive income is pretty much the number one term that I see a lot of people use. And now you just said it. It's that term that is working well for you for your ads. I'm curious as to, because we have passive income, we have tax strategies or savings, and we have wealth preservation. Those different keywords attract a different type of investor, correct?
Yeah, absolutely. And the passive income wealth without Wall Street, some people thought it was a class. So we found it was too vague in some cases. And, people were getting people clicking through that, weren't really looking to invest. They're just looking for education. So we've made a number of mistakes. We're constantly trying to hone in on that as well of what's broad enough to get someone to click and be interested, what's not. So we can't run an ad on bonus depreciation. I mean, maybe a few people that are so keen to hone in on it, but I think that might be too. And some of this is like Hunter stuff. We're really trying to continually dive in. Well, Russell Brunson stuff. We're really trying to dive in on the avatar. And for me, I everyone's are different, and almost everyone's going after people that have passive and want passive income. But for me, it's like I have the kind of the former New York or the people living in high tax states that are just paying a lot of taxes that have most of their money in Wall Street and want to have some diversification. And then we work a lot with kind of tired landlords, people who do want the K1 and people that know real estate already and know it could be a pain and a grind, and have all the war stories of dealing with tenants and evictions and generally want a more superior, more passive investment. So those are the areas that we're really trying to dive into more. And I connect with both of those types of people because a lot of people have one avatar. If you're a pilot, okay, you got a pilot avatar. If you're an ex-tech person, but I've actually lived almost two different lives. I was the real estate entrepreneur first, and then kind of backed into the Wall Street side. And so I've lived both. So I guess I have two avatars, and I'm a Gemini. So they say that have a split personality anyway.
Gotcha. All right. So let me make sure I understand your two avatars here. So your avatar that's attracted to passive income, they're busy working, working professionals, and then the other avatar that are living in high tax states that are interested in your sort of alternative investing. Is that correct? Did I just describe your two avatars correctly, or can you share with us?
Yeah, I think you hit the nail on the head there. And we're still figuring. I don't know that we'll ever settle on one. I think those are two solid avatars, and they're and largely both want passive income just for different reasons. So some of it's more in the, how do you talk to them versus the ultimate message is probably the same. So it's not that different than if you're a tech person, other than just there's different ways to identify, with a tech person. You may hone in on more of what their spouse does and help them with, same thing. If you're hiring a tech person or you're hiring a Wall Street person, the real estate professional for the spouse is the same conversation. The changing jobs and doing rolling over the IRA, that's the same conversation. So a lot of the content's the same. It's really how do you get their attention?
Right. I want to touch on your mastermind, your alternative investor mastermind. Is that a pay mastermind, or is it a free mastermind that you do for your investors?
So it's free for now. We have, and it's also the name of the podcast. So my podcast is not just syndication focused. It's really just everything outside of, the traditional stocks and bonds. So, we had a precious metals guy on, I've had some options traders on. We may have a Bitcoin person on.
Okay.
It's really just to explore kind of everything outside. I also, I'm very into points and miles and travel. And since we have a lot of entrepreneurs that follow, I'll talk about points and miles, travel hacking, just because, most people, if you have enough money to be an accredited investor, most people like to travel and when they can too. So it's really just an extension. And then we do have a Facebook group for it that, we're, it's still small and growing, but just a place where we can, share resources. And, what I found a lot of people are lacking is and I've gotten this feedback from a lot of investors, is just, having that one place to go of like, who do I go to roll over my 401k? Who do I, is infinite banking life insurance a good deal or not? Or how do I find the guy who's not going to rip me off and charge me and give me the deal that has such a high commission, but give me the one where I could borrow 95% of my money? Where it's actually not a bad deal for infinite banking. If there's anyone who's in the insurance business here, I'm not crapping on infinite banking, but I think it's important to get the one that's where you make less commission and it's a better deal for the investor.
Right. Yeah, I love that. Yeah, I love that idea. You get my mind going there with that mastermind idea. You've been in this business for a long time. You've raised a lot of money, both from institutional as well as these retail investors. For someone new coming in to this industry, especially now, coming in now and starting their first, let's say, $1 million capital raise, or even their first $10 million capital raise, what are some of the top tips that you would have for them?
You just got to put yourself out there. My first few $100,000 I raised by accident. That $3 billion fund came to me because I was selling mortgages on LinkedIn, non-performing loans. I wasn't advertising to raise money. I was just out there transacting. And because I was out there just transacting and doing deals, I got on the CIO's radar, and they reached out to me for an informational meeting. So you just got to get into the business. And once that happens, whether you end up raising money institutionally, I think just build your brand, build your list, add value whichever way you can. And that works for everyone. Not everyone needs to be a, crazy outgoing salesperson. For every wild and crazy salesperson like me, you need an analyst, you need somebody that handles the details and the blocking and tackling. So, you plug in however you can. You don't always need to be the talking head talking to the camera. You can be providing written content, and just got to be, you got to get into the game. And I guess to some extent, fake it till you make it if you're brand new, but not faking it, but by just getting in, help people for free, just to add value, be part of the team and learn as you go.
Right, exactly. Yep. What are some of your favorite tools or software that you use?
We still do, use some Excel. We've been messing around with some of the AI, chat GPT type of things for content. Dabble in StreamYard recently, which similar to Zoom, but lets you pre-record something, but then you could go live with it later. So we're dabbling in that. And I don't do my own video editing, but I am kind of trying to learn a little bit more about the video side of it. I was a later adopter to that. I was trying to be kind of this aloof behind the scenes, former finance guy, but ultimately you see me at a conference, though I don't shut up about moving to Puerto Rico to save on taxes or depreciation. So I'm starting to let my personality fly a little more. So I'm trying to dive into the ways to do that in a way that fits my, my travel, my lifestyle.
Love that. Jack, thank you so much for your, generosity to be on here, share with us, everything about funds and everything about, capital raising. Thank you so much for doing that. For the folks that want to reach out to you, connect with you, invest with you, partner with you, where would you like to send them?
So, we're on all major social media, just under my name, Jack Krupey or JKM Investments. And then the website is JKM Investments. That's JKAM for JKAssetmanagement.com. And the podcast, which you can find from the website also, is called Alternative Investor Mastermind. And we're on Spotify, iTunes, and most of the major platforms.
Awesome. All right. Thank you, Jack.
My pleasure. Thank you so much for having me.